What is going on, everybody? Dan again, Stocktrades.ca. Welcome back to the Stocktrades YouTube channel. Now, you might have noticed over the last few weeks, we haven't really been pushing out that much content on the YouTube channel. We're instead focusing more on the Stocktrades blog end and, most importantly, the Stocktrades premium end. YouTube finance, just finance content in general on YouTube is considerably slowing down, and I really don't blame people. They're outside. It's really nice outside. They want to get out. They're not paying attention to the markets. Typically there is a massive slowdown in the markets in June and July, so I don't necessarily blame you for wanting to get out and not paying attention to the markets. But we are still going to provide as much content as feasibly possible on the YouTube channel. But you might just expect a little less videos from us moving forward until we get into the fall and winter when things start to ramp up again. But what we are going to be doing moving forward is taking heavy requests from members in terms of what they want to see, whether that be YouTube subscribers or even email subscribers. And in this week's video, we're going to primarily be focusing on an industry that many members are questioning right now in terms of a potential inflation hedge. I'm going to discuss some current trends and whether or not they will protect you in an inflationary environment. Plus, I'm going to show you 5 top stocks inside of this industry that have the chance to outperform moving forward. And that sector is the gold sector. So with that being said, let's get started. So gold has very commonly been known as a proper hedge to inflation. But the reality of it is, and this is the pretty big error that I stated before the video introduction that a lot of investors get confused with, there is almost no correlation towards a rising inflationary environment and the price of gold. Now, if you're thinking I'm wrong, just bear with me as I go over this chart. So if we look to the rate of inflation in Canada since the late 1970s, which is essentially when Y-charts started tracking the inflation rate here in Canada, we can see that even during short durations of rising inflation, the price of gold doesn't really follow that much. I mean, especially if we look to post-financial crisis when the price of gold has soared while inflation has stayed relatively the same. But there is a pretty big correlation to a specific type of inflation in terms of the price of gold. And that is something like a rapid inflationary environment like we see here in the early 1980s in this graph. Inflation rise from anywhere from 8% to upwards of 13%. And in this situation, we can see a rapid spike in the price of gold. And as we move forward to post-financial crisis, when rapid inflationary fears were a real thing. I mean, we can go back to March of 2008 when the inflation rate here in Canada was about 1.35%, and over the course of that year it jumped upwards of 3.5%, and as a result the price of gold skyrocketed. And we can see right now post-COVID that when the inflationary fears, at least rapid inflationary fears, have come back, the price of gold has skyrocketed again. So putting it all together, no, gold is not a guaranteed inflation hedge in times of normal rising inflation, but there is a strong correlation between a rising price in gold in a rapid inflationary environment. And even though we're told this is not going to be the case, there is a lot of investors that simply don't believe what they're being told. And as such, they want to hedge their portfolio to gold. So is now the perfect time to buy gold stocks? Well, the simple answer is no. The time to buy gold stocks would have been when gold stocks were completely in the tank. But is it the perfect time? No, but is it an excellent time? I would say yes. There is much more room for gold to rise. In fact, some analysts have gold prices pegged at $2,000 an ounce, US dollars. At these price points, especially when we consider some low-cost producers, these gold companies are turning over so much cash, it is ridiculous. My portfolio personally, in terms of a gold hedge, I own Kirkland Lake. I hold gold at all times. I don't try and time it. I don't try to buy the lows and sell the peaks. I simply hold a position in a single gold producer that I believe is one of the best in class. But with that being said, besides Kirkland Lake, let's look at another 5 top gold stocks. We have some junior options on this list. We have some blue chip stocks, and I really think you're going to like the research put into these 5 options, and this video is going to be jam-packed. So with that being said, let's get started with our first option, which is Argonaut Gold. So we're going to start the list off with the smallest of the bunch in terms of market cap with Argonaut Gold. They trade under the ticker AR on the TSX. This company has been among the best gold stock performers through the first 6 months in 2021, and it currently has gains of around 11.31% year to date. The best part about Argonaut is it appears to be very attractively valued. This is a company that's trading at only 8.1 times forward earnings and has a price to earnings to growth ratio of 0.3, which, if you don't know what the PEG ratio is, it simply takes the company's price to earnings ratio and compares it to its estimated growth rates moving forward. So this is essentially a sign that the company's stock price is not keeping up with expected growth rates. If you see a PEG under 1, it's typically a good thing. But again, remember to figure out what year length your PEG ratio is using. Here at Stocktrades, we use the 2-year PEG, but there is a lot of companies like Yahoo Finance who use 5-year. So in the last quarter, the company set records in terms of quarterly production and revenue, and this is a trend that is very likely going to continue throughout the year. They are transitioning from essentially a high-cost junior producer to an intermediate producer with much lower costs. So the company has 3 producing assets: El Castillo, La Colorado, and Florida Canyon, with 2 more in development, including the much anticipated Magino project in Ontario, which expects to deliver first production in early 2023. So in terms of production growth, they're expected to grow production by 13% to around 230,000 ounces at the mid-range in fiscal 2021, while costs are expected to remain pretty much stable. It looks to reach 300,000 to 500,000 ounces over the next few years, and costs are expected to trend downwards, especially when Magino comes online. So this is a company that is going to grow production at a rapid clip. This is a company that has much higher than average all-in sustaining costs. They're in the $1,200 range. So this isn't a company like Kirkland Lake, who is in the high $600 range. But as I mentioned, the Magino project expects to have all-in sustaining costs of around $711 an ounce in the first 5 years of its operation. So this will end up lowering those costs. So if we span the company's returns out to a 5-year period, clearly this has not been a wise investment for Canadians. But as we can see, post-COVID crash in a rising gold environment, this company has performed exceptionally well. And if we even scale that back to a 3-year return, you can see that Argonaut Gold has returned 40.5% to investors. So if you're going to invest in a junior/intermediate player in Argonaut, you have to understand that they do come with considerable risk, especially considerably more than the gold company we're going to talk about next, and that is Barrick Gold. They trade under the ticker ABX on the TSX. So with a market cap of around $954 million in Argonaut Gold, we've gone from one of the smallest to the world's largest in Barrick. It has a market cap of $47 billion. Barrick truly is worthy of being among the top gold stocks in the country. The company has struggled in 2021 as quarter 1 production came in below expectations, and it was also lower year over year. And as you can see by the chart, the company has lost in the 7 to 8% range year to date. So it has not performed very well. But the thing we need to understand is that the expectations were missed mainly due to planned maintenance, and the company expects the second half of production to outpace the first half. So Barrick is also making significant progress in reducing its debt. For the first time in years, the company has a negative debt to cash ratio. And that is right, the company's debt, net of cash, is sitting at around $500 million at the end of the first quarter. This is down from $3.5 billion only 2 short years ago. So debt reduction has been an absolute must, and the company is continuing to put itself in a strong financial position. So another thing that investors don't really know about, and this is kind of an added bonus inside of the video, is Barrick does have exposure to copper. In fact, 22% of production is copper, and given the current copper bull cycle, Barrick is well positioned to benefit. And it is also worth noting that Barrick is committed to returning cash to shareholders. So on top of having a 3-year dividend growth streak, which is not quite aristocrat level, but it's getting up there, we have no doubt Barrick will hit it. The company announced plans to return additional cash to shareholders via return of capital distribution. So the first $250 million payout at 14 cents per share was announced in May, along with its dividend of 9 cents per share, and the company expects to announce 2 additional return of capital distributions by the end of the year. Those will be announced in August and November respectively, and in total, it expects to return 42 cents per share to investors, which effectively gives it a forward yield of around 3.5%, which is one of the highest in the industry. The company's merger with Randgold Resources was a positive and is expected to lead to stronger cash flows, cost savings, and lower debt costs, and it also led to an increase in its quarterly dividend. So if we look to Barrick on a 5-year performance level, it's actually in the green. It's not really anything to write home about. It's only up 2.8% over the last half decade, and that is including reinvested dividends. But with the current gold environment expected moving forward, there is a very good chance Barrick does outperform. So we have a junior/intermediate producer in Argonaut who is expected to grow production moving forward. We have a blue chip option that has reduced its debt a ton in Barrick Gold. And now we're going to go back to the junior focus, and we're actually going to focus on a more speculative option, you could say, that has some pretty significantly discounted valuations, primarily due to some political jurisdiction troubles, and that is B2Gold. They trade under the ticker BTO. So we actually have had B2Gold on our radar for quite some time, and it hasn't quite delivered to the extent we believed it would. But we cannot ignore this company's valuation, growing production profile, and lowering cost profile. So if the company has such an attractive profile, then why has it struggled? And one of the main reasons is the fact that the company was unable to renew its exploration license for the Menankoto property. So the Menankoto property forms part of the Anaconda area and is located close to the Fekola mine license area. So Fekola is one of the company's low-cost flagship assets. It achieved commercial production in 2017, and while the company is continuing to negotiate with the Mali government, it certainly puts a damper on the company's outlook and does beg the question as to the safety of its Fekola mine. So as I mentioned prior to getting into B2Gold, these are exactly the risks when investing in companies that have assets in less safe geopolitical jurisdictions. That being said, the company has come out and said that the Fekola mine has not been affected in any way. So recent price weakness has led to B2Gold being a value play. According to our Y-Charts platform, it is the top ranked gold stock in terms of valuation, scoring a perfect 10 out of 10. And in terms of trading towards historical averages, this is a company that is trading at a near 30% discount to what it typically trades at. If we look to its forward price to earnings of 9.5, this is a company that over the last 3 years typically trades in the 16.5 range when it comes to price to earnings. So if you can handle the higher risk profile, this might be a company that you want to have a look at. They have a price target over the next 12 to 18 months of around $9.38, which does signal 87% upside according to its current price, and also does pay a dividend of 3.99%, one that is well covered by both earnings and free cash flows, with the dividend coming in at around 23% right now. So if we look out to a 5-year chart of B2Gold, it's returned around 30-31% over the last half decade. Again, this is with dividends reinvested. As you can see, finally towards the post-COVID crash and towards the middle of 2020, people were finally starting to realize how undervalued this stock was, but that was in a rising gold environment, and B2Gold did perform exceptionally well during that time. But as the price of gold started to fall and it started to have issues with its mines, you can see that it has taken a big hit in price. But again, 14 out of 16 analysts rate this company a buy. So if you're looking for a high risk, high reward option with some upside, B2Gold might be one you want to look at. Hey everybody, just a quick break from the video. Again, I want to ask you to smash that like button if you're really liking the video, and most importantly, head down below, subscribe to the channel, really helps us out. And if you're interested in Stocktrades Premium, there's a link in the description below that's going to get you a huge discount. But anyways, let's get back to the top gold stocks. So the next stock we're going to go over is Wesdome Gold. They trade under the ticker WDO on the TSX, and this is actually a very interesting play in the fact that this was a company that our growth stock screener over at Stocktrades Premium picked up and alerted to members, and it has been one of the best performing gold stocks of the year. In fact, if we look back to early mid-January when our screener started picking up this stock due to a revision up in growth estimates, it's gained almost 40% and has been an excellent option for those looking to get exposure to gold. However, the company still does have some upside, so let's take a look. So with a market cap of 1.79 billion, Wesdome is a relatively small company in the grand scheme of things in terms of other gold producers. But as I mentioned, it has been one of the better performing gold stocks in 2021. And the best part about it is the company is currently still trading at a 30% discount to historical averages and still at a pretty steep discount to its 52-week high of $15 per share. And analysts do have similar views, and the average 1-year price target implies around 19% upside. So one of the best things about Wesdome and its performance this year is the fact that 100% of its assets are located in Canada, and Canada is one of the safest gold jurisdictions to be operating in. It has a fully funded capital program in which it looks to expand reserves at its 2 flagship properties, Kiena and Eagle River. Kiena is expected to meaningfully contribute to production in the third quarter and is a key growth driver for the company. It's expected to have average annual production of around 80,000 ounces, and it's a low-cost mine with average all-in sustaining costs of $675,000 an ounce. And if you can imagine, if gold does hit $2,000 an ounce, how much cash flow this company will be generating. So thanks to Kiena, total revenue is expected to grow by around 55% next year, and earnings should more than double. These are the highest expected growth rates among all mid to large cap gold stocks. So if we look to 5-year performance of Wesdome, it has been a superb option for investors. By far the best on this list. It's gained around 525% over the last half decade. The company doesn't pay a dividend, so this is strictly capital appreciation. But in terms of the cash flow generation, it will be really interesting to see if this company does deploy a dividend in the future. So we are down to the last stock on our list. And I do want to reiterate that the order of this list doesn't really mean much. I just want to look at 5 opportunities. They aren't exactly the worst to best. In fact, we tried to bring a whole bunch of different gold stocks together so that you can get companies at different stages. I mean, we have Barrick, the blue chip, Argonaut, the junior producer. We have B2Gold, the value play. We have Wesdome, the fastest growth play. And now our final gold stock on this list is the streamer. And bonus time, this is a Stocktrades foundational stock pick, one of our 10 core holdings over at Stocktrades Premium, and that is Franco Nevada. They trade under the ticker FNV on the TSX. So Franco Nevada's recent performance has pretty much justified its position as a top gold stock in the country. When the pandemic was causing mine shutdowns, essentially their business model was allowing it to outperform. And it does continue to do so through the first half of 2021 and is one of the very few gold stocks besides Wesdome that is in positive territory in 2021. It is by far the best performing large cap, as it has double-digit returns of almost 20% that essentially trounce the double-digit losses experienced by the majority of its large cap peers. So why the big outperformance? As we've discussed many times before, Franco-Nevada is a streamer, and in a bearish environment, streamers will outperform producers. The first half of 2021 and the late half of 2020 is yet another example of this. So I'm not going to go too in depth with what a streamer is in this video. That's a whole other topic of conversation. But pretty much what Franco-Nevada will do is give money to gold producers to expand in return for lower than market priced gold in the future. So year in and year out, Franco-Nevada is a pillar of consistency. And interestingly enough, this company does have exposure to oil and gas. And while the company's exposure to oil and gas has certainly helped it during oil's current bull run, it is very much still a gold streaming play, and management aims to have about 80% of its revenue come from precious metals. So again, Franco-Nevada is not saddled with the high costs of capex and operational mining costs. This allows the company to generate considerable cash flows. In fact, it's one of the most reliable dividend options in the materials sector. It was the only one to maintain its dividend growth streak during the last bear market, and it has raised dividends for 12 straight years. That streak will be extended to 13 years as it raised its dividend by around 15.5% this past May. So if we look to the last 5 years in terms of returns for Franco-Nevada, it's returned essentially a double, around 99% at the time of filming this. Might be a little bit different when it hits YouTube, but probably not. It's going to be in and around that range. And this is exceptional returns from a company of this size, especially when you consider their stability and the fact that they are not exposed to the extreme volatility as a gold miner. So everybody, that's pretty much it for the video. Really hoped you liked it. Hope you liked these 5 gold options. I hope I brought to light some of the impacts that inflation will have on gold stocks moving forward. In my opinion, I do think gold will hit $2,000 an ounce. I think it is a realistic target, especially considering the inflationary fears moving forward as we're seeing both Canada and the United States come out with higher than expected inflation numbers. Overall, I think it's really never a bad idea to hold a gold company in itself, whether it be a streamer or a producer. I don't really like timing the ups and downs of the market. I simply like to buy them and hold. I hold Kirkland Lake. It has provided outstanding returns, but these 5 options on this list will provide strong returns as well. Again, smash that like button, head down below, subscribe to the channel, and we'll be back with more amazing Canadian content, maybe less frequently, but packed with way more detail like this video, and you're not going to want to miss out. So we'll see you next time.